Hello everyone. Welcome back to part two of these special property transactions. We're going to deal with installment sales. This is the idea that someone buys a property from you, and instead of paying you all at once, they pay you over time. As long as there is at least one payment past the year of sale, then it can be considered an installment sale. This is an elective thing. You can elect to report it using installment sale rules. So first thing you need to remember is that interest income is involved, and if there is not interest specifically stated, then we're going to have to figure it out implicitly into the installments. So we're going to focus on the situation where the interest income is sufficient, meaning it's the correct interest rate, and that income, the interest itself, is going to be reported as income, just like what we learned back in chapter 3 and 4 about interest. So we'll separate out the interest, handle that the way we would any interest, and then we deal with just the amount that is what we would refer to as the principal, some of which is return of basis and some is gain. So each of those payments, absent the interest, has to be split between the return of basis and the gain. So we do that with using the gross profit percentage, which is gross profit is sales minus the basis, adjusted basis. It equals your gross profit. You divide that by the contract price. So if the amount that we're going to sell it for is all the payments, not including interest. So if I were going to sell it for $5 now and $5 next year and $5 the next year, that would be a total of $15. So that would be the amount realized, and we would then subtract from that the basis, and that would give us our gross profit, and then we take that gross profit and divide it by that $15 or contract price to get the gross profit percentage. So once we have the gross profit percentage, then we take that percentage and multiply it by all subsequent receipts of just not the interest, but the amount besides the interest we receive each year. Okay? So once you've got say a 60% profit margin or profit percentage, then if you got a $10,000 installment payment during the year, plus interest, report the interest the normal way, take the $10,000, multiply it by your gross profit percentage, and that's how much you would have recorded as a gain in the current year. The rest of it is return of basis. Now, some limitations. Can't use this if you're a dealer, meaning you can't sell inventory using this method. Cannot be used on publicly traded stock. I don't know how you would do that anyway, because when you sell publicly traded stock, it has to be done in a specific way. That's the whole point of publicly traded stock. But that's the rule, just in case you find out some way around that. And the thing that really can hurt you is any depreciation recapture is recognized all in the year the asset is disposed of. So it doesn't matter how many years you're going to get payments for. If you have depreciation recapture, then that all gets recorded and taxed as income in the year you sold the property. So really, installment sales is not for anything that has depreciation recapture. So really, you're only talking about things that don't have. It's not quite so bad with buildings and stuff like that, but it's not going to work very well with equipment or things that have very high depreciation and therefore lots of depreciation recapture. All right, sale residence. This rule basically means that if you sell your house at a gain, the one that you live in most of the time, or your primary residence, you are not going to have to pay tax on the gain. This is an exclusion, not a deferral like the others we talked about. Installment sale, involuntary conversion, all those do is postpone the gain till later. This one actually makes it go away. It has nothing to do with what you replace it with. So it doesn't need to be like kind. It doesn't need to be, you don't have to buy another house. All you have to do is qualify and sell your personal residence. So what does it take to qualify? During the 5-year period before the sale, you have to own the house for at least 2 years and lived in the main home for at least as your main home for at least 2 years during that 5-year anytime, and they don't have to be continuous. It doesn't have to be the same 2 years that you use in ownership. So it's very flexible. They really did want to make it as easy to use as possible, and you can even have a partial if you had to move. So basically, it ends up being the most you could do this is every 2 years. You could literally buy a house and move and change every 2 years and be okay. Each year you'd be able to defer the gain or get rid of the gain or not report it. But even that isn't good enough. I mean, that sounds pretty generous on the tax law, but if you had to move because of health reasons, the doctor told you that, hey, you got to stop hanging out in Pennsylvania. There's too many allergies here. You're going to have to move to Arizona. And you just bought a new house. You may be able to exclude some of the gain by selling it for that reason, or because you got transferred. Basically, you look at the amount that you can exclude and look at it as how long of the 2 years. So if your total amount you get to exclude is $500,000 because you're married filing jointly, and you only had the house for a year, then you could your limit would be $250,000 or half of the $500,000 normally. Okay, if you had it for only 6 months, that would be a fourth of the total 2 years that you needed it and needed to do to qualify, and so you'd only get $125,000 of the exclusion. So it's still pretty generous. Basically means that sale of your personal residence, unless you are sitting on a huge increase in the value, is not going to be taxable. All right, then the bad news. That was a good news, positive thing. Usually allows you to tell your clients happy things. This is a situation where they're going to clamp down on losses. So this doesn't apply to gains. If you have a self-implemented gain for either of these issues, the taxes is the same, whether it is a related party sale or a wash sale, doesn't matter. The gains work the same as any normal gains. But if there is a loss, if you sold something at a loss for less than your basis to a related party, you do not get to record that loss. You do not get the tax benefit of that loss. It does not get added to the basis. However, that loss will be able to reduce, it's postponed if you will, not really eliminated, until the person that you sell it to sells it to an unrelated party. So I sold an antique to my brother at a loss. So I bought it for $100. I sell it to them for $50. So I can write off or deduct that $50 loss. The reason why this is in the law is because people would take advantage of that and record that loss. Well, if you're selling to your brother or to another related party, the chances of you doing it just to make a loss is pretty high. So, but your brother now has a basis in that of $50. They go and sell it for $200. They can offset, so they have a basis of $50, $200 sale. That's a gain of $150. They can wipe out 50 of that gain because of the disallowed loss on the earlier sale. So they would only have a loss of a gain of $100. And all it can do is offset gains, okay? It can't make the loss bigger, all right, when they resell it. So that's the idea, and the related party is pretty broad, so you have to be careful as to what might constitute a family member or related businesses if you own stock in more than one business. Wash sales work very similar in that the losses are going to be postponed or disallowed, if you will. If you buy stock in a company or have stock in a company and you sell it and you buy the same company stock either 30 days before or 30 days after, so there's a 61-day period. The day you sell it and 60 days around that, 30 days on either side, where you can't, if you buy the same stock, you could have your what's called a wash sale, and your loss will be disallowed. If you sold 100 shares and you buy back 50, then only half of the loss would be disallowed. The other half would be allowed because you didn't replace all of it. Your disallowed loss is added to the basis going forward, and so when you sell it in a normal sale, you'll have the higher basis, which will allow you to get a bigger loss or a less gain in the future. So basically, the idea was you don't want taxpayers to benefit from selling a stock and getting a loss if they're just going to turn around and rebuy the stock, meaning they didn't really change ownership. They just sold it and bought it in order to get a tax benefit. If you're willing to wait 30 days or do it 30 days ahead of time, then it's okay. But if you do it in that period of time, then you're going to have a wash sale and you're going to have it disallowed. Most of the time, brokers, your investment brokers will indicate on your brokerage statement that when you sold a particular stock that you rebought, that it qualifies as a wash sale. They'll usually note that on their reporting to you at the end of the year. So it's not as if you're not going to get some help in being able to know when this has taken place.